Good day, participants. In the series of our webinars, today we will be covering the topic Life Insurance Policy Analysis, which is Chapter 10 of the subject Risk Management and Insurance Planning, Module 2 of the CFP program. Talking about this chapter, Life Insurance Policy Analysis, this chapter, by the end of this lecture, you will be knowing about the types of life insurance plans, about the various policy provisions, the various benefits of those plans, about riders, what are riders, the benefits of the riders. Let us take a look at the various type of plans today. Types of insurance, life insurance plans. As most of the participants know, that life insurance plans are sold on individual basis and they are also sold on group insurance basis. There are basic generic plans of insurance which are sold on individual basis. The same plans can also be sold to a group of people. We will be talking about group insurance in our later chapters. Talking about the type of insurance plan, the basic insurance plan is term insurance. As most of the participants know that basically life insurance is a device by which the risk of the life of a person is covered, and on the death of the person, a particular sum assured is given. Term insurance is the basic insurance wherein on the payment of a premium, a life insurance policy is given for a particular term. This term can range from 5 years to 30 years, which is generally given by insurers in India. During this term, if the life assured dies during the term, then a particular sum assured amount is given to the nominee or the beneficiary of the life assured. In case the life assured doesn't die within the term of the policy, that is on the maturity period, there is no maturity amount. Or in other words, we can say there are no survival benefits. It's a pure insurance plan. Some of the participants may feel surprised that who would take this plan, because the general notion in the marketplace, the general perception of the customer is that out of a life insurance plan, people get some amount when the plan matures, but this plan doesn't give when it matures. Who would take this plan? Well, this plan, the premiums are very low in this plan. As you know that insurance is based on sharing of risks and sharing of losses. So basically it's a pool of funds. So all the people who have joined this plan, they have contributed their share of premium in this plan. So this is the pool of funds. So during this term, every year, whosoever has died, a sum of money, say X, has been given to that person's family. So at the end of the term, there would be nothing left in this pool to be given to that person. So basically, the premium in this case, the premium consists of, number one is mortality charges. What are mortality charges? Mortality charges are the premium which is required to cover the risk of a person, to cover the mortality risk of a person for 1 year. And basically it is derived from mortality rate. Mortality rate is the rate of death of a person of a given age in 1 year. So therefore, mortality charges on the age of the person. And number two, expenses. Various expenses like sales commissions, underwriting expenses, administration charges, policy issuance charges, etc. So only these two components have been charged in this premium. There is no component charged so that insurers can give this money back to the customer at the end of the term. So therefore, they are the most simplest type of plans, very simple to administer. And only the death risk is covered. Now there are various applications of term insurance. Term insurance, it is very much used for in mortgage redemption policies, wherein if a person has taken a housing loan or any other kind of loan, so he can protect his loan against this kind of policy. This is basically it's nothing but it's a reducing term insurance. What happens in this particular case in the generic term insurance plan, if say the sum assured is say 5 lakh rupees and a person has taken it for a term of say 20 years, then the sum assured would remain constant 5 lakh throughout the term of the policy till the end. Even if a person were to die in the last year, the sum assured would be given as 5 lakh rupees. Whereas at the end of the plan, nothing is given, the plan comes to an end. Whereas in this case, mortgage redemption policy, which is reducing term insurance, for example, a person has taken a loan of 5 lakh rupees. So basically it is covering the outstanding loan. So for example, his loan period is 20 years. Let us assume that this person would be repaying his principal amount by 1 lakh rupees every year along with the interest. But the principal amount he is repaying, let's say 50,000, sorry. So next year it will be, after 1 year his outstanding would be, let's consider 50,000 is his principal repayment amount, 4.5 lakh. After another year it would be say 4 lakh, then 3.5 lakh, then 3 lakh, and so on. So what happens, this insurance, the sum assured would be equivalent to the outstanding amount in his mortgage plan. So therefore it is on reducing basis. So therefore the premiums would be still lower than this, because here the premiums have been calculated on the basis of 5 lakh rupees, because in life insurance premiums are based on level premium concept. The same premium would be charged. So here the premium would be, the mean of this sum assured would be, if we calculate the premiums on this mean, the premium would be still lower. There is another kind of plan which is used in the market these days. Basically what happens in this case, if the sum assured is 5 lakh, it doesn't take care of the inflation. After say 15 years, after 10 years, the value of 5 lakh would reduce because of inflationary conditions. So what happens these days, insurers are also coming up with plan which is known as increasing sum assured. What happens in this case, for example, in the first year, the sum assured is 5 lakh. They may say, one of the plan may say that every year the sum assured will increase by say 10%. So it is 5.5 lakh in the second year. Third year, 10%, again 10% of say the base amount. So that is 50,000, it will be increasing by 50,000 every year. So it will be 6 lakh by the end of the second year. It will be 6.5 lakh. So if the plan is of 20 years, so you can well imagine what will be the sum assured at the end of the plan. It may go into crores and it will be adaptable to the times. Similarly, there can be another situation wherein the company may say for first 5 years the sum assured would remain the same, 5 lakh. In the sixth year, after every 5 years interval, the sum assured will increase by 50%. So that means at the end of 5 years, the sum assured may be 7.5 lakh. Then for another 5 lakh, 5 years, it would remain the same. Then again, there will be a rise of 50% on the basic sum assured. So this is basic term insurance policy wherein the premium is taken only of the risk portion. Now we go to another important basic plan which is known as the pure endowment plan. Pure endowment plan is just the reverse of the term insurance plan. Here we are saying that sum assured is payable only on death in term insurance and no payment on maturity, no maturity amount or no survival benefits. It's just the opposite, that sum assured is payable only on survival and no sum assured on death. Participants again would be feeling surprised that what this plan is all about. Who will take such plan? Basically, pure endowment plan is not sold in its generic form. Basically, it's a component which is added to term insurance to make other plans. It's like salt and pepper, which we don't consume it standalone basis, but when it is sprinkled or when it is absorbed in a particular dish, it enhances the flavor and the taste of that dish. So therefore, pure endowment plans are merged with term insurance plan to form new plans, which are known as endowment plans. So endowment plans are the combination of term assurance plans plus pure endowment plans, wherein we have taken one component of term insurance, that death risk is covered, and here benefits are also given on survival. So therefore, endowment plans, we can say that sum assured is given on death or on survival, whichever is earlier. So if death takes place within the term of the policy, then sum assured is given, or if death is inevitable, death has to come to any person who has taken birth on this earth. But that if the death takes place within the term of the policy, if death doesn't take place within the term of the policy, so at the end of the term, the sum assured would be given, which will be known as the maturity benefit. We have another plan which comes in between the term insurance plan and the endowment plan, which is known as the whole life insurance plan. Whole life insurance plan is the extension of the term insurance plan only. It's a further, you can say, corollary of the term insurance plan. Term insurance plan, as I said, generally are given within a term of 5 years to 30 years, which is the trend in the insurance marketplace. Whereas, for example, a person who is of age 20 years now, he has taken a term insurance, let's say he has tried to avail the full term of 30 years. So even after availing the full term of 30 years, by the time he is 50 years of age, he would be uninsured. So he may still need an insurance after this term. Another case, a person of 18 years of age, taken up term insurance for 20 years. So at the end of the plan, that person is 38 years. He would still need a term insurance. So at that time, it would be very costly because of the inflationary times and because of the age also. So if there is a plan which can cover the whole life of a person. So basically, whole life insurance is a term insurance covering till the whole life of a person. Now, natural, obvious question which would erupt in the mind of the participants is that how do you define whole life? What is a whole life? A person may live up to 50 years, another person may live up to 70 years, another person may live up to 85 years. So how do you define whole life? What is a whole life? Well, if we see the life expectancy the world over, life expectancy in our country also, it depends, it varies from region to region, it depends on the gender also, it depends on the living conditions also. But basically, insurers have been providing this whole life insurance till the age of 100 years. And if you look at the statistics, very fewer persons who may live till the age of 100 years. Most of the people, more than 99% people would die before the age of 100 years. So basically, you can say that it encompasses the full life of a person. Some insurance companies have also designed their plans that they give a maturity amount also on reaching this 100 years of age. In case a person is still alive at the age of 100 years, then a survival benefit or a maturity benefit is also given. So it's basically somewhere in the middle of term insurance and endowment plan, but basically they are term insurance plans. Here also in all these plans there can be limited premium payment plans, wherein the insured person need not give a premium for the whole life. For example, in the whole life insurance, a person is not supposed to pay premiums when he is 85 years of age or 90 years of age. So one can opt for a limited payment plan also. Now, let's take a look at the various types of endowment plans. Now, all the plans fall under endowment plans. Let's see endowment plan, types of endowment plans. The most popular type of endowment plan is money back endowment plan, or simply they are known as money back plans. Previously they used to be known as anticipated endowment plans. But now more popularly they are known as money back plans. What happens in a money back plan? As we had seen in an endowment plan, the sum assured is given either on death or on maturity, but on maturity it is given in lump sum. Whereas in money back plans, instead of giving the sum assured in lump sum at the end of the plan, it is given in installments. To make it very simple, it is given in installments during the term of the policy. And the intervals could be regular, or intervals could be well defined by the insurers. For example, let's take a very simple example of a term insurance plan. For example, a person has taken a policy of a sum assured of say 1 lakh rupees for a term of, let's say, 20 years. So a conventional money back plan would say that after first 5 years, they will give 20% of the sum assured. Sum assured is 1 lakh, so 20% of the sum assured is 20,000. Similarly, after next 5 years, which is the end of 10 years, again 20% of the sum assured, that is again 20,000 would be given. So these would be known as survival benefits. These would be given if the insured person is alive on that particular day. Now, after next 5 years, this is end of 15 years. Again, 20% of the sum assured would be given. So again, 20,000 has been given. So participants will see that 60,000 have already been given to the life assured. Now, after the next 5 years, that is the end of the term, which is 20 years. Now, 60% have already been given. So rest remaining amount is 40% of the sum assured, which would be given, that is 40,000 would be given. So like this, 60 plus 40, 1 lakh rupees have been given to the life assured. Now, the most interesting part of this money back insurance is what happens if the insured dies in between the plan. What happens if he dies between this period and this period? Let's first of all take a look. If the insured person dies before this first 5 years, then sum assured of 1 lakh would be given. No survival benefit would be given because these are known as survival benefits. These would be given only if the insured person is alive on that particular date. So he will have to, his family will have to forego all these benefits. These are known as survival benefits. Only they will get 1 lakh rupees. So basically what is happening here in this case, you can see very clearly that pure endowment and term insurance are working concurrently in this kind of plan. If the life assured dies before the first 5 years, he gets only the term insurance part. This is pure endowment, which is given only on survival, not on death. So basically this is pure endowment which is working here in this case. So he doesn't get anything. Now if he dies between the first 5 years and the next 5 years, if the death takes place here, 20% has been given, doesn't matter. The full life sum assured of 1 lakh rupees would be given. So basically this sum assured is a part of term insurance plan. Because in term insurance, full amount would be given. This was part of pure endowment and so on. Now let's take a quick look. Now there are various other plans. Endowment plans can be formed for children. Endowment plans can be formed for joint life policies for husband and wife. So there can be different ways to design these kind of plans. Money back plans can be for a term of 20 years. They can be for a term of 25 years nowadays. Shorter terms are also being offered, like 9 years plans, even 12 years plans. Even money back plans are being offered seeing the inflationary conditions also. For example, after first 3 years, 20% would be given. After next 3 years, 30% would be given. So like that, because the need of the person increases with the passage of time. So like that, in that fashion, the plans are being designed. Now let's look at the type of endowment. Another classification of endowment. It's not a classification, but we would say benefits. You must have heard about bonuses. Bonuses are given in the policy. What are those bonuses? So basically, those bonuses are given only in endowment policies. They cannot be given in term insurance policies. So in endowment policies, there are again two kind of plans. One is known as with profit plans, and other is known as without profit plans. With profit plans are also known as participating plans, and without profits are known as non-participating plans. With profit plans are those plans which are, in a very simple fashion we can say, which are eligible for bonus. So they are eligible for bonus. Whereas these plans are not eligible for bonus, without profit plans. Basically, the insurers are sharing their surplus funds with the policyholders. Whenever the claims, expected claims are more than the actual claims, or in other words, the actual claims are less than the expected claims, so there would be surplus in the life fund with the insurers. So there is a rule that insurers have to share 90% of that surplus with the policyholders, whereas 10% of that surplus can be shared among the shareholders of the insurers. So that 90% of surplus is distributed among the policyholders, which is known as bonus. So a bonus would vary from year to year, and it may happen that in a particular year there may not be any bonus, whereas in another year there could be less bonus, there could be more bonus, so like that. Obviously, the premiums for with profit plans would be more than without profit plans. The extra premium which is being taken in with profit policies also many times contribute to the surplus. Now we come to another important kind of endowment plan which is very much popular these days, which are known as unit-linked plans. If we see the scenario around us, we see that banks had started reducing their interest rates in the past 7-8 years. All other financial institutions are also giving very less returns. So insurers also used to invest that saving component in an endowment plan, because the reason why they were able to give the maturity amount of the survival benefits was because besides the component of mortality, expenses, there was another component which was a saving component which they used to investment. So you can say it's EMI. One EMI, we know that it's equated monthly installment, but this EMI is, the components of the premium. E is for expenses, M is for mortality, and I is for investment. So basically there are three components of which constitute the premium of an insurer. So this part, investment, this extra amount was being invested in safe funds like government securities and treasuries, etc. So that's why they were saying that there is a sum assured. Instead of insured, they were saying we will give you this amount of money at the end of the term or at regular intervals as survival benefits. But we were not able to give high returns. Now people had more options to invest their money in mutual funds and stock markets and in other derivative markets, etc. So therefore, insurers also said, okay, we will also invest your money in those funds and we would endeavor to give you better returns because you want to invest your money, so we will do that for you. So therefore, unit-linked plans came into picture. It's also an endowment plan, but the only thing is that these two components are working as it is, expenses and mortality. Although there are several expenses because the investments is being done in mutual funds and equities. Here also the customer is given options. Some according to the risk appetite of a person can take more risk, then 80 to 90% can be invested in equity or equity fund. Similarly, those people who don't want to take much of a risk, their money can be invested in secured funds, or sometimes we also call them money market funds. So it could depend, 80 to 90%. Some companies call it growth fund, some companies call it secured fund. So here it can be 70 to 80. Then there is another kind of fund which is known as balanced fund. It could be any ratio like 40-60, 40 in equity, 60 in secured funds, or in money market fund it could be 60-40, it could be 30-70, it could be 39, or the balance amount here. So at the very inception of the policy, a proposal is taken from the insured as to how he wants his funds to be allocated, and otherwise in between also the investor is given choices. A person can switch his fund from one fund to another fund depending on the market conditions. Now we come to another important ingredients of life insurance plans, which are known as riders. There are some limitations to some of the endowment plans, like the sum assured remains constant over a period of time, unless and until it is an increasing term insurance plans, which have come only recently. Otherwise, previous times we used to have only constant sum assured. So there was an alternative which was given to the customers, that they can opt for riders. Riders is a clause or it's a condition to enhance the sum assured in lieu of an extra premium. That extra premium is a nominal premium in comparison to the basic premium. For example, the sum assured is say 2 lakh rupees, which is known as the basic sum assured. The basic premium for this sum assured at a particular age and for a particular term of the policy, let's say it is the basic premium is say rupees 5,000. For example, if we say that if this person happens to die by an accident, then this basic sum assured would be doubled plus 2 lakh, so that the beneficiary gets 4 lakhs. This additional sum assured of 2 lakh can be opted by the life assured by payment of an extra premium. This extra premium rupee 1 per thousand sum assured. For example, 1 rupee for 1,000 sum assured. If the sum assured is 2 lakh, then it will be just 200. So for this 2 lakh, the life assured had to pay 5,000 rupees, but for this additional 2 lakh, he has to shell out only 200 rupees. But this additional 2 lakh rupees is in lieu of a rider, which is known as accidental death benefit rider or ADB rider. Some insurers also call it double accident benefit rider, DAB rider also. So that they are saying that the sum assured is double, but it's not necessary that the sum assured may be double. But let's say it is doubled in this case. So, but there is a condition that the death should only be due to accidents, and accidents are defined by the insurers. Under what condition? There are certain exclusions also, but this sum assured, the death could be due to any cause. So some of the riders which are popular are accidental death benefit rider. There can be another rider which is called waiver of premium rider, wherein if the insured opts for this rider, in case if it's for a children policy or a child education plan, then the plan would continue, but the premiums would be waived off in case of the death of the guardian or the life assured in the policy. The life assured is generally the guardian or the parent whose name has been specified in the policy. So the premiums can be waived off. Similarly, there is another rider which is called permanent disability benefit. So in case, sometimes it may happen that after an accident a person may not die, but may become crippled, may become disabled. The arms could be amputated, some fingers could be amputated, a person may become blind. So all those specified disabilities which may render a person unemployable, which may render a person without any income. So in that condition also, either a sum assured can be given or the premiums can be waived off, or there can be both the benefits given under this rider. Similarly, there is another rider which is known as critical illness rider. Previously, it used to be known as dreaded disease rider. So critical illness, there are certain illnesses which are specified by the insurers, like kidney transplant, heart attacks, bypass surgery, paralysis, coma. So there are certain illnesses, 8 to 10 to 12 illnesses, depending from one insurer to another insurer. So in case that disease occurs to the life assured during the term of the policy, the said benefits under this rider are immediately reimbursed to the life assured, and the basic sum assured remains intact. So basically, riders can enhance the sum assured by paying a small sum of money, and purely optional. A person may take it at the inception. Sometimes some of the riders he can also opt in the middle of the policy. For example, accidental death benefit rider, permanent disability, he can opt. There can be other riders which he may not opt, like critical illness rider. So depending on rider to rider, they can be added, they can be removed also in between the policy. So thank you, participants.